Hello guys, so today I want to show you how it is important or how risk management is important. So let me show you now this, especially when it comes to highly volatile markets. Now look at this is boom 1000 index. Okay, now from this boom 1000 index I was using my moving average here, you know, to detect the movement of this market, the next market movement, and this market is really now going downwards. So let's assume I had waited for this moving average to come on top of this market to take a sell trade, and that's what I did. I took a sell trade from this level where my pointer is touching. Now I was expecting this market to go down all this way. Okay, now my analysis was not wrong at all. Okay, but what if I applied I used a very big multiplier with my stake? What would happen? This market took me down there and then it was hit by a spike. Okay, and then this spike took me to back where I was when I was entering that market. So that means all the profit that I had made here was wiped by this spike. Okay, so now me waiting for this market now to continue now going downwards, as very many traders do in this market. I would try to wait for this market to come down. Okay, just for this market to be hit by another spike. Now if I had not used proper risk management, this spike would have wiped a very huge amount of my stake and even go beyond my stop loss. Okay, so now my stop loss was not touched. Okay, now this market now started to come down. Okay, it came down all this way, and then I had anticipated my market to come from all that point up to this level, and now my take profit was 1. Okay, but how you use risk can come to your advantage in this way. Let's assume I entered into this position. Right now this is the 5 minutes chart, I guess. I think so. Let me check. Yes, it's 5 minutes chart. So one candlestick takes 5 minutes. Now let's assume I used a very big multiplier here with my spike. It's either it goes two ways. Using high risk, it can either affect you positively or negatively. This is how it can affect you negatively. If a positively, sorry. No, let's assume I took my stake here, and let's assume my stake was $100. Okay, then I used a very big multiplier like that. Let's assume my take profit was $80 and my stop loss was $15. Of course I know one spike is going to take more than $15 from my stop loss, so maybe let me use $25. Okay, now if I used the biggest multiplier here, okay, which is the times 400, and now this market came all this way. If by the moment this market was reaching here to be hit by this spike had already given me my take profit, that's one advantage of using high risk. But the disadvantage is, what if my take profit had not been reached up to this point? That means all my profits was wiped away. Okay, so this is what you do if you're using high risk. If you're using high risk, just take reasonable take profits. Just take reasonable take profits if you're using high risk, but don't use high risk if you're not sure, or at least if your strategy is not, if you're not sure whether it's going to be hit by a spike or not. Don't use high risk. Use only high risk where you are almost, let's say, 90% sure that that market is going to go your way. because high risk has advantages and disadvantages. So if you want to use that leverage to your advantage, ensure that 90% of the probability is going to work for you. And if you're not sure, please don't even enter into that market. Okay, so guys, see you next time. It's my pleasure to see most of you have subscribed to my channel. Most of you are viewing this content. I'm here so that we can help one another, guys, and I'm always proud, you know, to see, you know, new members. So kindly share, comment there, and like this video so that we can help this video to reach as many people as possible, so that we can help them on how to become good traders, profitable traders. Yes, man. So let's see one another next time. Let's keep peace. Thank you.